Gold hasn't quite had a spot moment happen to it and go rally like crazy over the past week and a half, so it could be interesting to look at a gold stock as it's just beginning to start to rally. So today we're going to be looking at Newmont Corporation. So let's not waste any time and get right into it, but first, smash that like button. Now, let's go look at this stock.
Alright, so today, as I just said, we have Newmont Corp here on the TSX. It trades with the ticker NGT, and on the New York Stock Exchange, NEM. They are trading at $60 a share just about, with a market cap of about $47 billion. They have a reasonable PE of about 16.69, and, well, not about, that's their exact PE, and they have a dividend yield of 3.69%. So, let's quickly look at their charts here. I'm not doing any technical analysis, I don't know how to do that, but just to show, on the max side, they are near all-time highs, which makes sense. Gold itself is, though that could also be worrying for some people that it is at an all-time high, depending on what you think of that. This is the New York Stock Exchange chart because, of course, it has higher volume, but we can see here in the last 6 months, it has pulled back significantly, though it's just started to come back up in recent days. Alright, so 9 world-class assets in top-tier jurisdictions, so they have over several million ounces of gold reserves in each of these mines here, and they all have well over a decade of reserve life, which is good. You don't want these mines running out in 2 to 3 years. They also have AISCs well below gold's current pricing, which is, of course, a good thing. You want their profit margins to be large and not non-existent. It's good to see here that their production is meant to stay steady at about 8 million gold equivalent ounces per year, because that would suck if their production was decreasing while gold's price increased, because if it was decreasing an equal amount to gold's price increase, then their revenue would be flat, and that wouldn't be fun. Though, of course, their profit margins would still widen, but you get the point. And so we see here, they actually expect, because we only had about 6 million ounces of gold equivalent ounces delivered in 2020 with an AISC of $1,000 per ounce. They actually expect their AISC to decline, with their total gold equivalent ounces set to increase to about that 8 million mark we saw above. So that's, of course, a good thing. That'll help their profit margins widen and their revenue increase because they're producing more combined with gold's price rising. You get the gist. They, of course, are getting more projects built up so that they are able to continue mining even as those current mines run out, but even those current ones don't run out for over 10 years. And they have quite a few ready to go, basically. So we see here 94 million ounces of gold reserves and 65 million ounces of gold equivalent reserves. And so we can see here that that is made up of 75% copper. So if you're not bullish on copper, yeah, of course, you're not going to like that, right? We have 41 billion copper pounds and 1.3 billion silver ounces here. And for this, we see 88% of it's located in the Americas and Australia, but in general, it's still very diversified across the globe. They're, of course, working on exploring so that they, again, don't run out of gold mines. ESG-wise, they did really good. You can see a whole bunch of different rankings here. 6 years as the top-ranked gold miner in the Dow Jones Sustainability Index. That's always good to see. Now, strong financial performance in the second quarter. We see they significantly outperformed quarter 2 2020, though to be fair, that's also when the lockdowns were like the worst. So that does, of course, give a huge advantage to 2021, but still we see about 150% increase in net income and 30% for revenue. And I looked at the Q1 presentation, and again, Newmont similarly outperformed Q1 20 compared to Q1 21. So I will, of course, be factoring that into the discounted free cash flow analysis. Since it starts with 2020, 2021 is the first estimation year, I'll, of course, factor in their already proven 2021 cash flows. So we have Newmont's revenue here compared to the average gold price per year. Right side we have the gold price, left side we have their revenue. Of course, it matches almost identically their revenue to the gold price. Makes sense considering they are selling gold, though with some anomalies like 2012 decreasing despite an increase in gold price. So of course they were just producing a little less that year. And we can see their revenue and gold price CAGR are almost identical as well. For earnings per share versus gold price per year, we can see that even in years where gold price is higher, they had some years like 2013 higher gold price than the bottom in 2015, but were extremely negative, though in the last couple years we have seen it shoot right up along with gold price. And just comparing that to net income, we could see these charts look almost identical, so they haven't been doing any weird stuff with shares outstanding, which is good. And we can see, though, 2019 and 2020, that net income is almost identical, so though we saw from here, it's likely going to be a lot higher for 2021. Now, jumping over some management numbers, return on invested capital, we see 9.31%. You, of course, want that to be above the weighted average cost of capital and above 2%. We see substantially above that with 9.31%, though that's still not anything to write home about. Now, return on equity, the S&P 500 average is 14%. Below 10% is bad, so we can see here 12.3%, so not good, not bad, just okay. So looking at the discounted free cash flow here, we'd see using the weighted average cost of capital, a 920% upside. So we're just going to ignore that. That does not make sense. And that's a ridiculous discount rate either way. But you always want to include what the weighted average cost of capital looks like. We see with a standard 8%, we see 65% upside. And with a more conservative 10%, which I prefer to use, we see a 19% upside. And this discounted free cash flow I'm using assumes 16% revenue growth after 2021, which is the average of the past 4 years, and 30% for 2021 itself, as we saw here. And this is also using past profit margin averages, so if gold jumps, those margins would of course expand, though input costs like oil could negate those profit margin expansions. Though they expect their AISC to decline, that'll of course expand the profit margins, though who knows why they expect those AISC to decline. I only read through the presentation, so I'm not sure. But we can see that here, overall, it does look, okay, there's a decent amount of upside here, just depending which discount rate you prefer and your risk tolerance, since, of course, this gold is either way is going to be a lot less risky than, say, a uranium company, though in turn, not quite as much upside. That's, of course, up to you if you want to get it or not. But thanks for watching, and I will see you next time. Oh, and this is not financial advice, so I just talk like that when I say you or we. I kind of just talk like that. Not financial advice. Do your own research. Now, end of video.